Hey everyone, it's Kristen with Gunderson CFO and Bookkeeping. Today I want to talk to y'all about long-term rentals and I actually have an example. I went through this with a client yesterday. So let me go ahead and share my screen. All right, y'all should be able to see this spreadsheet right now. So when we had our meeting yesterday, I went through and asked her the questions. Well, how much did you purchase it for? They purchased it for $250,000. They put $10,000 as a down payment, and their loan was for 242. Based off of, I think it's a 2.75 interest rate for 30 years. Their mortgage payment is $988. They are going to go ahead and put in $20,000 worth of improvements. And then one thing that we did have to figure out is we had to figure out how much was the building value and how much was the land value. Based off of their tax records, 89% of it is being taxed as building value. So we get to depreciate the building, the house, and then we also get to depreciate the big improvements that they're doing to the house. So this ends up being about $7,600 that we get to depreciate every single year for like 29 and a half years. And then the improvements we get to depreciate $1,300 over the next 15 years, approximately. So found out more information. It's a 5-bedroom. And I think about 2,700 square feet. I think they said 2 or 3 bathrooms, big yard and everything. So they think that they can rent it out for $5,000, $3,000 to $5,000. So I gave them, I told them that they need to go reach out to a real estate professional to figure out what some good comps are for rentals in that property. And they want to do like a midterm to long term, like a month-to-month rental instead of a short-term rental. And those are completely different. Last week I talked about short-term rentals and how it can benefit you. And they actually get put onto your tax return on a different spot. If it classifies as a short-term rental, it gets put on as a Schedule C instead of as a long-term or mid-term rental, it gets put on as a Schedule E. So, and the difference is that if it's a Schedule E, you do not have to pay Social Security and Medicare tax on it. It just gets added to your tax bracket and taxes that you owe. Whereas if it's a Schedule C, you do have to pay Social Security and Medicare taxes on the profit, the net profit that you have. So we went through, because I actually think we decided that it was going to be 4,000, but then include all of the utilities in this price. That's why we went up to $5,000. So it's going to include the propane, the electric, the internet, all that stuff. So that's how we decided on the $5,000 for just right now. We also decided that there's probably going to be about 12 weeks out of the year, 3 months where it's not going to be rented. So we have a 23% vacancy rate. And then I also put in all of their expenses, their property taxes, their insurance, just incidental repairs and maintenance, like if the toilet breaks or if they need to touch up a wall or something. Administrative fees, they're going to actually have a company do the property management for them on this. That way they really don't have to worry about it. And then I just took in variable costs of 12%. So it that may come to about 5,500, maybe more or less, depending on how things go. And then the utilities, we figured out how much the utilities was with the propane and the snow removal and the shoveling and all that. So they're going to be bringing in, based off of their vacancy rate, $46,000 on this home, right? Like they're gonna go travel in an RV. Like they're gonna put their home on like a midterm rental. They're gonna bring in $46,000. I'm calculating their expenses to be about almost 25,000. And then their net cash flow, and then so 21,000 minus their mortgage payments of almost 12,000. So the people who are renting are going to be paying off their mortgage for them. And then their total cash flow is going to be $9,600. So they'll have an extra $9,600. And what they want to do is they want to like remodel the bathroom. Like every year they want to do a new remodel on the house, right? So one things to take into consideration is on the tax return. Like, are they going to pay taxes on $21,000, even though their monthly increase, their monthly stuff has increased 21,000, or after they're paying off their mortgage, they're really increasing about 9,600. We'll say 10 grand. Are they going to pay taxes on the 10 grand? No. So based off of, you can't write off a mortgage, but you can write off the mortgage interest. So we have the 21,000. I'm gonna plug this into my calculator. 21, we'll say 500. And then they have the interest for the year. So this year's, say they rented at the beginning of the year. So that's 50, we'll say $5,800 worth of mortgage interest that they get to deduct. And then I told you we get to depreciate the cost of the building and improvements. That is $8,900 that they get to depreciate. That's, not coming out of their pocket. So that brings it down to, they're going to be paying taxes on only $6,800 approximately, even though their cash has increased really 2,100 or 21,000, pay down their mortgage. They're left over with almost $10,000, and they're only going to be paying taxes on about 6,800 of it. And remember, they don't have to pay Social Security or Medicare taxes on this. And they get to depreciate it. It turns out to be a really great deal. Their cash flow is 9,600. Their cash return on investments are going to be 30%. This is why you do real estate. Their cash return on investment is going to be 30% this year. And then their total return on investment, including the appreciation, we've been calculating how much their house has been appreciating in worth. It's appreciating at a 23% rate every single year. So the total return on investment is going to be 303%. That's pretty amazing. So there's a few things that I do want you to know about. A lot of times, rental properties will actually, because of the depreciation, they'll actually be a negative on your tax return. Like you'll have a loss on your tax return because of the depreciation, even though it is a positive cash flow. And I can do that spreadsheet for any one of my tax advisory clients. Like that is stuff that I do with them to make sure that before we buy the property or before we list a rental, or what we should, like if they're considering it, I do that for every single one of their properties. But the other thing that I want you to know about is, if you have a loss, can you take the loss against your W-2 wages? Well, that's what I want to talk with you about right now. Let me pull up my next spreadsheet. Okay, let me see if I can share my screen again. Okay. So I have a PDF. So one second.